From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, May 11th. Here are the top market stories that we're following for you at this hour. Hot inflation whips markets. You got stocks and bonds find a floor after investors face higher inflation and a potentially more aggressive Fed. And Biden's struggle, recession risk. Former New York Fed President Bill Dudley said there's nothing the White House can do about high inflation except tighten fiscal policy. We're going to speak to Jason Furman, former council chairman of Economic Advisors. And retail's inflation problem, supply chains to higher labor costs cloud the environment for retailers. We speak to Jennifer Hyman of Rent the Runway to get her take. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I find it quite interesting that the only part of the markets that seem to be steady in the direction is the front end of the curve, higher yields.
Yeah, it kind of makes sense, doesn't it? And we'll talk about our question of the day in just a moment, what the bond market is signaling. What I'm really struggling with today, Alex, is what is happening in the equity market. Even the NASDAQ going positive, which seems kind of illogical if you think about where rates potentially could be going. Certainly, that is what the short end is signaling, that they are going higher. The dollar's also down. I'm struggling with that one a little bit. Yeah, Lagarde signaled that we are going to be seeing a rate rise potentially in July out of the ECB, but the Fed's going to have to be more aggressive than the ECB by some considerable margin. Europe is in stagnation, like Nagel's talking about that over in the Bundesbank effectively. You've got the German government talking about that. You've got a whole range of ECB speakers referencing that. So I am genuinely, Alex, struggling with the price action a little bit today outside of the bond market. And that kind of does take us to our question of the day, which is kind of, will the recession be necessary? Will a recession be necessary to control inflation? And I think that's what the market is grappling with today. So we welcome now onto the show Bloomberg's international economics and policy correspondent, Mike McKee. I'm just going to take a little bit of a pause here because I want to see if he's wearing a tie.
He is wearing a tie.
Excellent.
You're right. He left them all here.
Yeah, he left them clearly in his desk in New York when he went to California and Florida and then to the islands. On the other hand, Ira is not wearing a tie. Our chief U.S. rate strategist, Ira Jersey, joining us from Bloomberg Intelligence. Ira, I'm going to start with you. The bond market seems like a sort of an area of relative calm today in some ways. It is pricing, I think, a logical story going forward, i.e. we are going to need a recession here. Front-end yields up really quite strongly. 10 years not up by quite so much. The Fed's going to have to raise aggressively, and it's going to slow down growth in the near term. Is that what we're seeing here?
Well, I would argue that we're pricing for growth to be slower in the longer term, not necessarily the near term. In fact, I think the market's pricing for near-term growth to be pretty good, right? So this whole idea that, we're not going to be in a recession in the next, 9 to 12 months is probably accurate. But the market certainly is thinking, hey, we're going to be in a very significant growth slowdown toward the end of 23 and into 2024. And my personal view is that it's going to be very difficult for the Federal Reserve not to continue to hike until such time as demand for goods and services slows significantly. And that's going to cause a recession. Now, how deep that recession is, I think, is important. And, right now that the market's pricing for a relatively deep recession, but it doesn't have to be, right? Because we do have a lot of underlying data that is coming in relatively strong and on the consumer side and others. So I think the jury is still out on how deep that recession will be, but it's hard to imagine we don't have one if inflation is going to come down to, say, under 4%.
Yeah, Mike, that's what you were basically trying to get Loretta Mester to say yesterday. What kind of recession that we were going to be expecting. Did you learn anything in Florida about that?
I don't think that there's anything new in it. The Fed is going to be tightening, and they are going to tighten until inflation starts to come down. Now, we're talking about a year out here. What's the inertial situation with inflation by then? Does the Fed have enough tightening in the markets by then? We'll have to see. It's not going to change their views right now. And it is interesting that we say the Fed is going to cause a recession. The Fed didn't necessarily cause the inflation. They may have played a role in not tightening soon enough, but the recession would just come from it because history shows that when you start tightening, the interest rate to bring down inflation, you do get recessions. And interesting thing about this chart here is take a look at the blue line and the white line. The blue line there is inflation, and the white line is the Fed funds rate. And the Fed has always had to raise the Fed funds rate above inflation to bring it down. And look at where inflation is right now. They have a long way to go.
Mike, let's just talk about that inflation and try and break it down a little bit. What we saw today looks like a strong core number, and I think there's probably some component parts which we need to discuss as to why that happened, and also clear evidence that we are seeing inflation shifting into services. Once inflation shifts into services, to my mind, it's harder to deal with. Is that what we're looking at here? And is that part of the problem that the Fed faces as well?
Well, it's part of the problem, but it's also part of the solution. Goods prices were really high. They've started to come down. That was expected as people rotate into services. And then what's going to happen is service prices are going to go up, but they're not going to go up by the same amount each month. They'll go up in the short term over a couple of months, and we'll see some big increases in service prices. And then that should level out as well. Some of the things in the core that really pushed it up, well, the biggest thing is housing prices. And the Fed has already pushed up mortgage rates over 5%, and home sales have started to fall off. Refinancing is dead. And so at this point, part of what the Fed needs to do is happening. It just takes a while to get into the numbers.
Hey, Ira, you said before that we do need to see a recession, but how deep is really the question. If you take a look at what's happening with the front end of the curve, how much more repricing do we need to see? Are we going to see that 75 basis point increase now priced in, or just kind of more 50s?
Yeah, my view is that the Federal Reserve is probably going to do more 50s as opposed to doing a 75, right? Because from their perspective, look, if they go 75 in July and then 25 in September, why not just go 50 and 50, right? You're only talking about a 6-week gap between that. So I think that 50 basis points is now going to be the new normal hike, at least for this cycle, maybe not in future cycles, but for this cycle, we're going to go 50s. And I think that the Fed's not going to stop until it does see inflation momentum have rolled over very significantly. Now, interestingly, I'm looking at implied forward inflation priced by the market. So I'm using inflation swaps, zero coupon inflation swaps that you can find on the Bloomberg terminal. And they're telling me right now that we're going to have 2.7% inflation in 2023, 2024, and 2025. So that's still above that 2% target. So, even right now, market expectation is that the Fed's not going to be able to get back to its long-term target over the next couple of years.
The president just issued a statement. The president saying he is confident that the Fed will do its job on inflation. President Biden saying inflation remains, quote, unacceptably high. Mike, to Ira's point about the fact that the market believes that the Fed is going to struggle to get inflation back down to target, what else do we need to see here? Does Joe Biden need to play a role in this process? Do we need to see, as maybe Bill Dudley is suggesting, actually that the government gets restrictive here as well? Do we actually see both sides of the ledger, as it were, fiscal and monetary, tightening in kind of unison, and that is how we're going to squeeze it out?
Well, we are seeing a bit of tightening in fiscal policy, certainly a lot of tightening from last year and the year before, because the pandemic aid is no longer coming through. But the problem with fiscal policy, it just takes a very long time. Even if they all decided in Washington to pass some measure today to spend a little bit less money, the money that's already committed is going to be spent out over the next couple of months, and it isn't going to affect inflation. So, no, there's really nothing that Joe Biden can do at this point unless he can convince oil drillers to ramp up production or something like that. It's really on the Fed.
Not unless you have energy stocks at record highs. That's what would happen. That's the thing that would really tip the scales there. Ira, last word to you. Is the bear steepener going to be the way forward? Oh, sorry, bear flattener the way forward?
Yeah, I think we're going to continue to bear flatten. When you look at where forward markets are currently pricing, we are pricing for the curve to invert. So twos tends to be at negative territory, and I do think that eventually we'll get there.
Guys, thanks a lot. I really appreciate it. Nice to see both of you. Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence. Nevertheless, you still have equities now on the highs of the session. S&P up by 0.6%. So where do you invest while inflation is running hot? The market's telling you energy. Well, does Christina Dudley agree? She'll be joining us next, a Franklin Mutual Advisors investment strategist and portfolio manager. This is Bloomberg.
Inflation's critical.
These numbers obviously are too hot. So, this is a bit of a shock to the upside.
When does inflation start to ease? We talked
The
about
peak, which looks like it is in now on a year-over-year basis, is potentially a lot less important than where these numbers settle or where the plateau is.
Inflation is the rise in prices, so it doesn't mean we're seeing peak prices.
That's still a major problem for this bond market, a major problem for this Federal Reserve, and as we're seeing, a major problem for the valuations that support the S&P 500.
It will, of course, depend on the path for inflation and how policy evolves thereafter.
Tight monetary policy is what's going to be required to get inflation under control.
Instant reaction from Bloomberg TV guests on how the Fed should react to inflation. That brings us to our question of the day. Will it take a recession to control inflation? The immediate market reaction if the number hit at 830 would suggest possibly yes, but now there's a bit more confusion with the S&P up by about 0.4%, bottoming out, turning around, energy leading the way. Katrina Dudley, portfolio manager at Franklin Mutual, joins us now. Katrina, weigh in on that. Does it take a recession to control inflation, and what does that mean for the markets?
I think recession is one way that we've historically seen that controls inflation. But let's go back and take a step back in time and have a look at, 18 months ago, we had a helicopter in the sky that was just dropping money down. And inflation is that 18 months hence outcome of having dropped down all of this monetary supply. So if we take a look at the Fed, what is the normal transmission mechanism of rates and to linking it back to inflation is the idea is if we increase interest rates, you then see a contraction in the fiscal budget as other expenses get crowded out, and that is what controls inflation. So if we get a fiscal policy that is a little tighter than it's been in the last couple of years, that's also a way we can start to control this inflation narrative.
As investors, what do we do with this, Katrina? I don't know yet, and I'm not sure the market does yet either. I don't know how far the Fed is going to have to go to get the economy, to get inflation under control. How do I price assets if I don't know the answer to that question?
Well, let's take a look what happened at the Bank of England and look at when they were looking at increasing rates and people are like, how can you do this when, food prices, energy prices, housing prices at our all-time highs and the inflation there. So the Fed is walking a fairly significant tightrope. I think the first thing we need to acknowledge is that the Fed was suspected to do 75 bips. It came in at 50. So they're actually slightly less hawkish than they've been, but they're balancing this against the fact that they are behind the curve. We probably should have seen these rate hikes happen earlier versus later. Now, they have the next few meetings, and I think that we're expecting a 50 basis point increase at the next meeting. Some people think it could be as high as 75. I think it's more likely to be 50, and they still do have the option of just tapering that down to maybe even not do 50, but do 25, 25, 25.
So, Katrina, what do you buy in that kind of scenario? I mean, no surprise, but Mike Wilson at Morgan Stanley continues to be relatively bearish. He likes defensives, he likes energy, real estate, utilities, healthcare. Those are kind of all the ones that are up today. Do you just kind of buy into that value trade then?
I think we have to be very careful about what we're using to predict what we need to buy to protect. Because if you take a look, the algorithms and the relationships that have worked for the last 15 years have been based on assumptions of low interest rate, free money, and zero country risk premium. And those three aspects of the equation have all changed. We know that the Fed is raising rates. The real yields are still negative because of the high inflation, but inflation is not going to be 1% going forward. I think consensus and expectations are that 3 to 4 range is where it settles down. I know the Fed's targeting 2, but I think it'll be higher. So you can't just say, let's go back into what worked last time. You need to really think about where do I want to be positioned going forward.
If that's the case, the Fed is going to have to be restrictive. It's going to have to go further than maybe the market is pricing at the moment. At the moment, the market is pricing kind of circa 3%. Bill Dudley's talking about 4% Fed fund rates, 5, 6, 7. Potentially we could go significantly higher than the market is pricing, Katrina. If that turns out to be the case, current models are wrong. The levels at which we have risk assets, risk-free assets are wrong. So how, as an investor, do you deal with that right now? Are you just putting your finger in the air and hoping? or is there anything can actually usefully tell us how we price these assets?
Okay, so let's think about where you don't want to be. When you're looking at a rising rate environment, profitless tech, which has sold off significantly, is a difficult area to be. When you're looking at rising risk and country risk premiums, you want to look at those countries where you have risk of expropriation of assets. We've seen that in Russia. I would say that we're cautiously looking at some of the risks in China and thinking about what happens there. The area where I think you've got a lot of opportunity for value is in stocks which are pricing in a recession, and that the recession we think that they're pricing in is a much more significant recession than we think is going to occur,
right,
and that we think that the business models have changed. So I think that there are a lot of opportunities. I think they're actually very different from what Mike Wilson is saying in going to the defensives. We're looking to buy some of the cyclical parts of the market that are overpricing in a recession. So it all comes down to valuation and expectations, but we think there's some really great opportunities out there.
Katrina, can you get more specific then on maybe the sectors or areas?
We like some of the industrial space. You've been talking about, more of the energy space and everything. I think obviously energy's had a very significant run, and you look at the stock prices there. On the energy complex, I think, Alex, in the break, we were talking about the fact that high energy stock prices may encourage these CEOs to invest. I think actually the opposite. Their high stock prices are reflecting the high commodity costs, but also the capital discipline that these companies are showing. And I think that they're in a bit of a conundrum because ESG is directing them to not invest. The fact that their stock prices is high is directing them not to invest. And so I think that they're coming in and investing, it will be a very difficult decision, and it'll be a lot longer decision than what you've seen in the past. On the cyclical side of the market, we're looking at some early cycle companies, and those early cycle companies are the ones that tend to go down first when the PMIs start dropping. And that's where we think of the market's been overly bearish and some really great opportunities.
Katrina, what have you got wrong recently? What is working, what's not working?
I think what I got wrong going into the beginning of this year is I didn't own enough hard assets. And so hard assets being the miners and we own very good position in the energy stocks, but we weren't really overweight into the mining stocks. And obviously you've seen a big rally in those stocks. They have come off somewhat. So I think that is the area where I wish, in hindsight, that I had some exposure that I don't. Some of these mining companies, though, if the commodity prices come down, the valuation will compress significantly, and they're so tethered to these commodity prices that it does make it difficult as an investor. And obviously there's such a small population of them, but I do subscribe to the fact that we actually have a different set of fangs that are going to drive the market going forward, and a lot of those new names are going to be in that hard asset category.
Great to catch up, Katrina. Really appreciate your time as ever. Katrina Dudley, Franklin Mutual Advisors, greatly appreciated. We're going to pivot. We're going to talk about some other assets that are having a tough time right now. How do you rescue a stable coin after it crashes? By definition, it's meant to be stable. Backers are trying to raise money for one. We'll talk about that next. This is Bloomberg. Another fun day in the crypto space. So the backers of Terra USD, the stablecoin, are hoping to now come to its rescue, and it's in need of rescue. The token is loosely pegged to the dollar, but today it's fallen all the way to 45 cents. Well, let's just actually take a look at the latest pricing. Where are we? 48, 49, but nevertheless, big drops coming through here, and the situation is fairly volatile. So what is it going to do? What is it going to be? What is it going to require to get this thing moving? Sonali Basak is here. Sonali, just walk me through the price action first of all. This is a very bumpy story that we're looking at here right now. We saw a spike a little while ago. That's faded very quickly. Just walk us what we've seen throughout this morning.
I think one thing that's very important to note here, Guy, is ever since the block had reported yesterday that the Luna Foundation would seek to shore up capital, raise more than $1 billion in order to stabilize this stablecoin, the prices have dropped even more. And you look at what's on CoinMarketCap, market cap, Terra's UST is down 46% to 49 cents in 24 hours. So that depegging is much more drastic. When you look at what it's trading on at Coinbase, it's actually lower than that. It's 38 cents. So there's a real risk for this stablecoin as it looks to shore up its peg to the dollar. But the question is, does this stablecoin survive at the end? Remember, this is a massive DeFi project. It runs on the Ethereum network. And the question is there systemic risks associated with a stablecoin depegging to this degree?
Yeah, let's talk about others. How are other stable coins, and I use the term loosely, it seems, how are others behaving?
Well, one thing that's interesting is to look at USDC, which is the Circle stablecoin that has a closer tie to the actual dollar, whereas Terra's stablecoin is actually more closely linked to Luna, which is a sister token that really traders arbitrage the two to make sure that the prices stay stable. It's an algorithmic stablecoin where the prices are not actually pegged to the US dollar. I think the question that is underpinning all of this and the question that underpins regulators is, to what extent do you start to see ripple effects in other asset classes beyond cryptocurrencies?
Yep. Okay, talk to me about how a rescue works. What happens? How does this process actually unfold?
It's funny. I've heard it described in a couple ways. If I had to use some of the market ways that folks are thinking about this is, you know, does it resemble Robinhood in the wake of the blow up that we saw, I guess now a couple of years ago? Or does it resemble an emerging market who loses their currency peg and needs shoring up? Another way that this has been talked about, for example, is Luna Foundation actually uses Bitcoin as reserve here. Do they need to sell more Bitcoin to keep their peg to the dollar when it comes to the UST Treasury? And any way you look at it, it is a shoring up of any fund. As you've seen, funds been shored up before, they need capital. The question is, what does that do in terms of confidence for anybody that has been trading Luna? And remember, the thing that's important to remember here is it's not just retail investors. Actually, there are big funds behind this. The question that remains is, what do firms like Galaxy, which has, it's Mike Novogratz's firm, which has long bet on Luna. Mike Novogratz actually has a Luna tattoo. He has been so bullish on the coin. And what does it mean for jump trading as well, that has been said to have some connection to Luna as well?
Absolutely. We are going to watch the space with interest, as you say, maybe some ripple effects into other areas. Shani Basek, thank you very much indeed. Equities are surging on both sides of the Atlantic. European stocks are up really strongly on the back of that inflation data. We're going to talk inflation data. Jason Furman's going to join us next. This is Bloomberg.
We're an hour into the U.S. trading session. Probably not what you expected we would see if you were looking at that CPI number at 8:30. Bloomberg's Abigail Doolittle is tracking all those moves for us. Hey, Abigail.
Hey, Alex. Well, yeah, really a wild day here for the S&P 500. These are the E-mini futures, so you can see for the overnight session up slightly and then higher into ahead of that CPI print, up more than 1%, and then down close to 1%, and now we're up about 0.9%. So this intraday volatility and trying to figure out what to make of that CPI print coming in hotter than expected, but perhaps not so surprising to everybody. And as was just mentioned, the 10-year yield basically staying flat. So an interesting day. What we do know, though, is behind this gain, it's very broad-based. If we go into the Bloomberg terminal and take a look at the IMAP, we are going to see most sectors are higher, led by three of the biggest inflation sectors, including energy, materials, and real estate. But even tech, sensitive to rates going higher, you have tech up just ever so slightly, now flipping lower. That's going to be the critical one on the day. As for some of the big movers behind the scenes, let's take a look at those, because it is a broad-based rally, not just from a sector standpoint, but also a stock standpoint. Not surprisingly, ExxonMobil up 3.2%, energy the strongest sector. Alphabet higher, though, so there you have a communication services name. JP Morgan, we finally have banks getting a bid with yields up a little bit, and then AMD, another tech name, up 3.9%. One area, Guy, though, that is not feeling much love, and that, of course, the home builders. On the year, huge declines for the likes of Lennar, D.R. Horton, and Toll Brothers. This, of course, as the 30-year mortgage rate here in the U.S. ticks up 2.5% to 5.6%. Really pretty incredible. So the housing market starting to not only just slow, but it's going to be interesting to see if it really falls in any sort of a big way, Guy.
one of the transmission mechanisms of higher rates potentially working its way into the US economy. Abigail Doolittle, thank you very much indeed. So it's a sign that inflation in the United States will probably persist at elevated levels for a longer period. That is the read on today's data. CPI rising by more than forecast in April. Here's what President Biden said yesterday about rising prices and the reaction to today's numbers by former New York Fed President Bill Dudley.
Inflation is our top economic challenge right now. I'm taking inflation very seriously, and it's my top domestic priority.
The president's ability to do something about inflation is extremely limited. Really, the only thing the president can do is get Congress to tighten fiscal policy to make the Fed's job a little bit more easy.
Joining us now, Jason Furman, Harvard University professor and former Council of Economic Advisors chairman. Jason, how do we get inflation down? It looks like it's more sticky than we anticipated. It's broader than we anticipated. Are we going to need a recession to get it under control?
Look, I hope not. I would go with the strategy of hope for the next 6 months. The strategy of hope is raise interest rates a decent amount, maybe put that 75 basis point increase back on the table, convince investors that you're going to keep going and the Fed funds rate could go well above 4. I don't know that that's going to be enough, but I'd try that before I try anything else.
Is it then really the question of what is leading inflation more, the supply or demand side? If it's the demand side, it feels like we have to have that demand destruction, hence a recession. If it's the supply side, maybe that's a different story.
I think this inflation is mostly demand driven. When I look at the past 6 months, I look at a surprisingly high level of demand for goods that has been sustained. At the same time, demand for services has risen month after month after month. That roughly matches what we're seeing in these inflation numbers. The service inflation has risen, core services, for 5 straight months now. That is very much a demand story because you've had a lot of workers returning to the labor force in those 5 months, but yet prices continue to rise faster and faster month after month.
In terms of what you see now in the market, Jason, and you're not a market strategist, but do you think we are underestimating the task still?
I think that the market is underestimating at the long end. When I look at something like the probability that the Fed funds rate rises above 4%, being close to 0, I think that's just nuts. 4% with inflation where it is right now might actually be the neutral rate. That might not even be a contractionary rate. So I think the Fed has done a good job of convincing everyone it's going to raise rates very quickly at the next couple of meetings. It needs to do a better job communicating that it may have to stay at the task for some time. We may need high rates. And by the way, a recession may not be enough to bring inflation back to where you want it to be. This may be something we're struggling with for years.
Okay, well, that's definitely a grimmer outlook. So if that's the case, if the Fed stays more aggressive for longer, maybe the terminal rate is a lot higher than we thought, et cetera, what else can be done? If that's not enough to bring inflation under control, what else needs to happen? Bill Dudley talking about we're going to have to see a contraction in fiscal policy for that to be the case.
Look, the White House doesn't have a lot of tools. One tool it does have is tariffs on China. It should do that to bring inflation down. Another tool it has is resuming interest payments on student debt. The unemployment rate for college graduates is in the 2s right now. We could resume that. That would also help bring inflation down. And then, Bill Dudley talked about fiscal policy and the fiscal contraction. I'd sort of wait 6 months, but if the monetary policy isn't working, 6 months, a year from now, we should be having a serious conversation about fiscal policy helping out.
Jason, isn't it the case, though, that we're already behind the curve? Waiting for another 6 months, isn't that a huge risk at this point?
Well, just to be clear, the Fed shouldn't be waiting, and the Fed isn't waiting. I mean, they're raising rates at 50 basis points a meeting.
But is that? But the Fed, what the Fed has currently got priced, the market, what is currently expected is clearly not going to be enough. So the Fed is going to remain behind the curve during the period that you're talking about, that 6 months. I appreciate what you're saying. We're not going to wait and see during this period. We are going to take action. But is there a danger that we're not going to be taking enough and we're still going to be behind the curve and we're going to have to do even more further down the road? What does even more further down the road look like?
Look, I have a high inflation forecast, but I might be wrong. I wouldn't sort of bet everything on my forecast being right. I think at this point, the thing you should do is say there's so much uncertainty, you're not going to change course until you see actual inflation come down. You're not going to act on the basis of forecast. You're going to act on the basis of data. And if the Fed is raising rates at 50 basis points, if they put 75 basis points back on the table, if they tell us rates may go above 4, a lot of that gets priced in advance to financial conditions. Financial conditions are doing a lot of work right now. What we've seen with the markets, what we've seen with mortgage rates.
Jason, can you tie that into politics with me for a second? Bloomberg has a big take kind of every day where they do a deep dive into certain topics. And in this one, they talk about inflation in Midland, Texas, which is very dependent on oil in the Permian Basin. And some of the anecdotes there are really staggering. Things like a gallon of milk costs $6. The Fed's not going to be able to do anything about that. That's going to have to come from somewhere else. What do you do if you're in the White House right now and you have midterms coming up around the corner and someone's paying $6 a gallon for milk?
Look, the president, one thing he did yesterday that was right was he did not overpromise. He did not say, don't worry, in a couple of months, this inflation is going away. He said it could be with us all year. He said it could be with us into next year. And so I think under promising and over delivering is a better strategy than the alternative. But there's no way to handle this until inflation comes down. There's a little bit they can do, drop the tariffs, resume the interest payments on student loans. But, beyond that, empathy, patience, not over-promising, that's really all you can do if you're sitting in the White House politically.
Jason, what did you make of the Bank of England's communication strategy? The Bank of England basically said, we're going to be tightening, but we're going to see a pretty aggressive recession. Is the Bank of England just kind of unclear on what the outcome is likely to be here, or do you think the Bank of England is the model on which other central banks ultimately are going to have to settle?
Look, the UK is the other country in the world that has inflation almost as high as the United States, not quite, but almost as high as the United States. And, they're probably saying what, we're going to be saying 6 months from now. Again, I don't, if the curve is if being with the curve means deliberately causing a recession based on the data we have now, I don't want to be with the curve. I won't mind being behind the curve, learning a little bit about what is needed. Again, the Fed's moves right now are, in historic terms, really, really aggressive in terms of the rate of change. In terms of the level, they're still very dovish setting. And I'd stick with that strategy, but be prepared to escalate.
So, Jason, to be able to do a little compare and contrast, if we look in the BOE, the Fed, and then the ECB, a big part of the conversation has also been the stronger dollar. Kind of what enables the dollar to cap? What's going to support the other currency markets? And I'm wondering the role of the dollar in your inflation and then potentially recession scenario.
Yeah. Look. Inflation in the United States, core inflation is running about 3 percentage points faster than it is in the euro area. There's a reason the ECB has moved much, much less than the Fed has moved. Even if they lift off sooner than they were planning, they're still going to be, and they still should be, way behind the Fed. So the dollar should be stronger. And that is yet another headwind for the US economy, along with lower equity prices and not incredibly high, but incredible increase in mortgage rates. So exchange rates, mortgage rates, the stock market, a lot of the Fed's job is being done for it right now, and for good reason.
Jason, we really appreciate your perspective. Perfect day to get it. Jason Furman, a Harvard University professor and former Council of Economic Advisors chairman, thank you very much. Can't believe that mortgage rate, 5.5%. That's unreal for 30-year, at least in the recent past. Coming up, we're going to look at how inflation is now hitting retail companies. We're going to talk with Rent the Runway CEO Jennifer Hyman. That's coming up next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Olivia Engel, the State Street Global Advisor CIO of Active Quant Equities. That's on Bloomberg TV, 3:30 p.m. New York time. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The U.S. House has approved a $40 billion emergency spending aid bill for Ukraine. The measure pays for new weapons and provides economic and humanitarian assistance, and it's significantly larger than the $33 billion President Biden asked for. The bill now heads over to the Senate, where approval is likely next week. The UK and the EU are at it again over the post-Brexit deal for Northern Ireland. UK's Foreign Secretary Liz Truss says the European Union's latest proposals on trading arrangements won't work. She signalled the UK would take unilateral steps if a new agreement can't be negotiated. Bloomberg's learned the EU is ready to suspend their trade deal if the UK revokes the Northern Ireland Protocol. And in Hong Kong, National Security Police reportedly have arrested 90-year-old Roman Catholic Cardinal Joseph Zen and 2 others for allegedly colluding with foreign forces. That is according to the South China Morning Post. The paper says the 3 are trustees of a fund which was established to provide assistance to those involved in anti-government protests. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alix.
All right, thanks so much, Ritika. As we've been talking about all morning, inflation is high, perhaps even stickier. Now, one company says that actually is an opportunity. That company, Rent the Runway. The apparel rental company says consumers will look for more affordable ways to get the clothes they need. And joining us now, Rent the Runway's CEO, Jennifer Hyman. Jennifer, great to see you.
So great to see you.
So talk to me about how you get your clothes and then how you deal with shipping them and renting them. And I want to get kind of a full picture of how you look at inflation, your input costs, and then what you can charge and how you navigate all of that in this really choppy environment.
Sure. So first, let's talk about the consumer. The prices of a piece of apparel have gone up 5% year over year. So now when you are getting an invitation to a wedding, and there's 2.6 million weddings this year, and you're making a more thoughtful choice. Do I need to buy this dress that I know that I'm only going to wear once or twice? Or is there a better option? Should I rent it? So I think that you have inflationary pressures where people are thinking about smarter decisions they want to make in terms of how they spend their money, coupled with the fact that you have a reopening where people actually want to experience life again, and they're spending their money on experiences, on concerts, on travel, etc. So it creates an incredible environment to kind of position Rent the Runway as a smarter way to get dressed for your everyday life, a smarter way to get dressed for your events. In terms of our inventory, we source our inventory directly from over 800 brands. And one of the key benefits of our platform is that we continue to monetize inventory over the course of multiple years. So we have an assortment on our platform that's new inventory from 2022, but also is inventory from previous years. So let's say there are supply chain issues where an order comes a week or 2 late. That doesn't really impact us in the same way that it impacts a traditional retailer, because we already have millions of items on our platform that women can choose from. So today we have one of the largest assortments of special occasion inventory, I would say, in the country, but certainly the largest assortment we've ever had, because we've been planning for this massive reopening of celebration.
So you make a compelling case. So then I'm wondering if you could talk a little bit about the stock price. What do you feel like investors are not getting? The shares are down so much since the IPO. What do they not understand then about that story? Does it need to be profitable? And if that is, when does that happen?
So we've outlined a clear plan of driving the business to free cash flow profitability, which is our #1 goal. We can do it with the cash that we have. We also laid out that we only need 300,000 subscribers to get the business to free cash flow profitability, and that our growth projections this year are for 45 to 50% growth this year alone. So we also have a community of millions of women who have rented the runway in the past for a special event. And we find that 50% of our subscribers actually come from former customers. So what this year is going to be about is building the funnel of customers that will fuel our growth not only this year, but fuel highly efficient growth for many years to come.
Jennifer, it's Guy in London. Is the average spend going to go up? You described the kind of the logic behind the model. In the current environment where consumers are being squeezed, are they going to be spending more or less?
Well, on our platform, we're providing the customer with 20x the GMV value for her spend. So when she spends $140 on a monthly subscription with us, she's getting $4,000 in retail value of clothing, which is actually now going up because the price of clothing is higher. So the savings are already there, the enormous financial value that we deliver to the customer, in addition to the fact that she doesn't have to pay for cleaning, that it comes directly to her, and she's not paying for the shipping on our platform. So I think that that's added benefit. Now, let's think about what happened during the last kind of recessionary environment in 2008. We saw that in that last recessionary environment, there were two massive things that happened in the apparel industry. Number one is people still bought clothes. They still bought 68 new articles of clothing per year. They changed the places that they consumed those clothing from. So you saw massive growth in off-price, so businesses like Ross or TJ Maxx, and you saw the emergences of businesses like Gilt Group, who were providing kind of high-value brands at low prices. At that point in time, we did not have the resale market as another kind of trade-down option. Now, Rent the Runway is an option, just like a TJ Maxx, just like a Shein, just like an H&M, for a more efficient way to express yourself and get dressed for the many things you have going on in your life.
So interesting that you mentioned that, because I also feel like competitors have been catching on to that. So now a lot of individual brands have either their own resale market, or they have their own rental option as well. That's a very different landscape than when you guys started. How do you manage that?
Well, I think that from the consumer standpoint, the reason why the consumer comes to us is for unlimited variety. She wants millions of choices. She wants the 800 brands. I think that the consumer doesn't want to wear the same brand all day, every single day. It's like, what's the value proposition of having a subscription just to Dua Lipa as opposed to having a subscription to Spotify? You want the world of music at your fingertips, just like Rent the Runway gives you the world of fashion. So we think it's fantastic that brands are, innovating and pushing and understanding that secondhand commerce is here to stay and has to be part of their business model. And that's why we have 100% retention of the 800 plus designer brands that we work with over 13 years.
Jennifer, is this special occasions or is this back to work as well? And what are people wearing as they come back to work?
So it is back to work. It's special occasions, it's vacations, it's everyday life. What we're finding across every single use case is they are wearing the most colorful, the most fashion forward, the most celebratory, and the most scandalous inventory that I have seen in 13 years of being in business. Now, let's talk about work specifically. So because most offices are coming back to work in a hybrid manner, what that means, and people haven't bought workwear for the past 2 years, it means that investing in a work wardrobe doesn't make the same financial sense anymore, because you don't know what you're going to wear to the office, you don't know how many days of the week you're going to be going in. So a subscription to fashion where you can kind of utilize that for work makes even more sense today than it did in the past. And we're finding that people are renting workwear from us, but it's totally different than what they rented in 2019. They're renting and feel more comfortable wearing more fashionable things to work, wearing more casual things to work, wearing a pink blazer as opposed to a black blazer, wearing a dress with a print on it as opposed to just wearing a black shift dress. And I think that that means for women that they have more choices, but it also leads them to need more variety. Women can't wear that same black suit to work anymore and shift out their blouse every single day.
Right. Guy has no idea what we're talking about. How many sweaters do you own, Guy?
Nope. Not many. 68 items of new clothing every year. I think it probably starts with a 6 with me. I'm not even sure I get that far, but it is just a 6.
I don't know. Yeah, I was going to say maybe 4. 6 is overdoing it there. But Jennifer, thanks a lot. We really appreciate your time today. Jennifer Hyman, Rent the Runway CEO, thank you very much. More on Guy's shopping habits. This is Bloomberg.
Circa half an hour to go till the European close. Let's talk about the price action over here. Stocks are roaring. It's luxury stocks, it's energy stocks, it's the car sector, all doing really well here in Europe. The Stock 600 up by 1.5%, well off its lows. We saw that CPI dip and we bounced very strongly off that intraday low. We are seeing the bond market on offer. We've got the German 10-year back well north of 1%. Keep an eye on what is happening there. BTPs, interestingly enough, are bid today. And then we come to actually one of the more interesting stories, I think, out of Europe today, and that is what is happening with nat gas. So this is the Dutch contract. It's down by around 5%, despite concerns about what is happening in Ukraine and the shutting off of one of the major entry points for Russian gas. We are seeing maybe warmer weather, the arrival of a lot of LNG into Europe as well, maybe just keeping the market relatively calm. So in the next hour, we're going to talk about this. We've got an exclusive conversation coming up. Yuri Vitrenko is going to join us again. He, of course, is the CEO of the Ukrainian gas company, Naftogaz. We're going to be talking to him next, trying to figure out exactly what is happening with that Russian transit of gas. We'll talk about it next. This is Bloomberg.